Let's talk about modeling risk, which is deceptively simple by definition. It's the risk that any model used by a bank or financial institution is not competent. Maybe it doesn't capture risk, maybe it values assets wrong, or any other type of loss caused by the incompetence of the model. Let's take a look. Let's talk about modeling risk. Modeling risk, put simply, is the risk of incurring losses due to the inappropriate use of modeling. That is, you have some sort of computer algorithm that spits out garbage, and that either affects asset valuations, or regulatory capital calculations, or any other number that will cause a major pain in some area. In specific, there are usually two classifications of model risk. Put simply, the first is using bad models. That is, you use a model that doesn't consider certain factors. It's the wrong model to use, period. The other variation is using a model that is good, but it's used in a bad way. That is, the model does consider all necessary factors, and it's a good model, but the data that is input is low quality, it's garbage, so the model spits out garbage results. An example of a bad model was the set of models used to calculate the risk of structured finance products near the Great Financial Crisis. None of them calculated the correlations among assets. A good model used in a bad way can be, for example, value at risk. You can use value at risk calculated with historical data, but twist the data. The model is good, but the results will be inaccurate because the inputs are as well. It's important to note here that the wrong use of models or the use of wrong models has been responsible for many financial problems, including the Great Financial Crisis of 2008. As we just mentioned, if you think about it, one major factor was that the models used by banks and other institutions did not capture the collective financial and economic risks of mortgage-backed securities, and therefore everybody in the market underestimated the real risk because the model did not show it. It's important to note that models are pervasive in banking and other financial activities, and they exist in almost every area of it. There is an algorithm to estimate a component of pretty much everything. The most common types of models in a bank, and arguably the most important ones, are the models used to calculate the regulatory capital for the three main risks. This is part of microprudential regulation, and these are the models used to calculate the capital that is required as a cushion against losses from these risks. It's important to note that under Basel regulation, there are multiple approaches to calculate these risks, and only the more advanced approaches use internal models. So it is possible to use what are called the standardized approaches, which don't need models to estimate these risks. But nevertheless, the first of the three is credit risk. So these are models that are used to calculate the key metrics in a credit portfolio. The approaches that are used to calculate internal ratings are called internal ratings-based approaches, or IRB approaches. This is because the bank does not rely on external ratings and generates their own models for internal ratings. There are two types, Foundation IRB and Advanced IRB. If the bank is using a Foundation IRB approach, they only need to calculate the probability of default for their loans. Everything else comes from their supervisor. However, if they are using the Advanced IRB, which is the next step, they need to calculate the probability of default, but also the LGD, or loss given default, and the EAD, or exposure at default. The second of these risks is market risk, and these are models that are used to calculate the risks of trading portfolios outside of banking. In any activity that involves trading, such as hedge funds, this will be done as well. So if the bank has not implemented the FRTB, or Fundamental Review of the Trading Book, they usually use a 99% confidence interval value at risk. If they have already implemented the FRTB, instead they use a 97.5 expected shortfall, and they calculate it for 5 different time frames and for all trading desks. For this type of model, historical data is very important because if you use data that are too positive, you get risks that are underestimated, and vice versa. And finally, we have models to calculate operational risk. So these models calculate operational risk losses based on historical data from the bank's individual departments. The models for this area in specific have proven to not be reliable, to the point where Basel regulators could not find a single pair of banks that using internal models for similar departments with similar revenues ever reached a similar value for the estimated losses. So out of the 3 risks, models for operational risk tend to be the least reliable. Besides for calculating regulatory capital, naturally, we have many other models in banking and outside of it, including to calculate product pricing, such as loans and deposits, to prevent payment fraud, using fraud scoring, and many others. A lot of them internal to the bank or institution, but they can be external as well, purchased or licensed. A great source of guidelines on how to deal with model risk comes from the Federal Reserve Board's Sr117 Guidance. In this document in specific, focuses on 3 key areas of model risk management. The first is model development and documentation. That is, the design of a model, the theory of it, and the logic of it should be documented, and it must be ensured that components work as intended. That is, you know the purpose of a model before you develop it, so that you're not surprised later if it veers off the path. You know what you want, and you can identify how every specific component is working. Also, the data quality used in testing must be high. Any artificial intelligence expert will know this. Garbage in, garbage out. A good algorithm must be trained with good data. Then, model validation is also necessary. That is, there must be independent validation. And independent means by people that are not the developers of the model to test the actual model, to ensure that the models are working as intended, in line with the objectives of those models. Think of this as analogous to an internal audit of a bank. An independent team goes in and gauges how the bank is complying with different areas. The same exact logic applies here. And finally, there must be procedures and policies for governance, policies, and controls. Documentation, for example, must be maintained for every single model, as well as keeping an inventory of all models that are in use, their results, and their issues, as well as what is the status of those issues. Have they been fixed? Are they planned to be fixed? And so on. We should also note that faulty modeling can create losses and due to a variety of different factors, some of them unexpected. Possibly the most obvious consequence is that using faulty models in trading can naturally create trading losses due to not properly estimating certain market factors. For example, a model estimates that there's no risk in a trade, but there is a lot of risk, and the trader loses. Then, inputting wrong assumptions can make banks or institutions overconfident about tough conditions. For example, since stress tests are usually done with very specific conditions, the bank can over-adjust their assets and their capital planning to the results of specific stress tests. So they succeed in those specific tests. But if there is a real downturn with different characteristics, then the bank implodes because they're not prepared for it. Or even worse, the bank is too confident and passes all possible stress tests with fine-tuned data and then fails in every case in reality. This has happened. Another possibility is not having credible models to estimate the regulatory capital requirements, and this results in supervisors imposing additional capital requirements. which reduces the capital structure efficiency. What I mean by this is the following. The standardized approach, for example, which does not use models, may result in 100 billion of capital, and the advanced model may be more efficient and result in 70 billion of capital. And remember, this is a cushion of capital that is set aside. It can't be invested, it can generate interest, so the lower it is, the better. But let's say that the bank is greedy and they tune the models to result in 50 billion of capital or even less. But then real losses occur, and they are of 70 billion or more. So the regulator doesn't trust the bank or their model anymore, and they tell them, you can't use an internal model anymore. You have to go back to the standardized approach. And now the bank has to set 100 billion aside instead of 70. This is what I mean. And finally, lack of proper governance can cause faulty models to run undetected, or even if they are detected, people may not know what to do. So all of the previous points are assuming that we know what's wrong with a model. But if we don't keep an inventory, we may not even know which models are running. There may be no documentation, you may have no idea how things are being calculated, and these models may have been running like this for the past year or even longer. Or it may be the case where the team knows that a model is wrong, but they don't have the skills to improve it. This is why governance and processes are so important. What are our examples for this lesson? The first is the complexity of the FRTB. So Basel's fundamental review of the trading book brings gigantic modeling challenges. It really is fundamental in nature. And this is both due to the complexity of the expected shortfall method, which replaces value at risk and requires more computational power, and now being calculated in 5 different timeframes, as well as for every single trading desk plus the total. But this is also due to the fact that the bank, besides the internal model approach, also needs to calculate the standardized approach. So they don't select between the two. They have to calculate both, and then they use the standardized approach as a floor to the calculations of the internal model 1. Then, as mentioned, in order to calculate regulatory risk capital under Basel, banks can either use standardized approaches, which involve no internal models and they just take weights from a table and they're multiplied by values, or they can use internal models, which estimate less capital, so they're more efficient, but they require more supervisory scrutiny, especially related to the model quality. In any bank or institution that fails in terms of internal models, because the model is not accurate or it's not credible, can be forced to go back to the standardized approach. The standardized model in the future is considered to be used as a floor for Basel IV. What I mean is that since Basel III and the fundamental review of the trading book, the Basel Committee has reached the very sad conclusion that most bank models are just not working and they're not credible. They always underestimate risk in some way. So in the future, even banks that leverage internal models will also have to calculate the standardized approach, and some percentage of the standardized approach results will be used as a floor. For example, the plan is for 50% of the standardized approach to be a floor, and after some years to raise it to 72.5. So let's take an example. Let's say that the standardized model says that you need 100 billion. 72.5 of that is 72.5 billion. Let's say that your internal models say that you only require 60 billion. Because 72.5 is the floor, that's what you always need as a minimum. This is to keep the internal models under check because regulators are not trusting them anymore. What are our key takeaways here? The first is that modeling risk refers to risk losses caused by faulty models. And this can occur due to bad models, which are deficient by design, or just using good models in the wrong way by feeding them bad information. Then, the Sr117 Guidance from the Federal Reserve Board provides three main areas of best practices for model risk management. First, models must be documented and identified. They must be validated independently, and there must be corporate governance processes regarding their use and management. Then, although there are models for almost everything in a bank or other financial institutions, some of the most relevant ones are the ones used to calculate regulatory capital under Basel's microprudential regulatory framework. Usually, there are models used to calculate regulatory capital for credit risk, market risk, and operational risk. That is, if the bank decides to use the internal models approach for each of these three categories. And finally, faulty models can create losses in both obvious and subtle ways. They can cause trading losses, they can make a bank cross risk thresholds, they can increase regulatory capital or decrease it so much that the bank is sanctioned by their supervisor and then the capital is increased because they're downgraded in their approach, and other possible ways. So as we're seeing, model risk can be caused by either bad models or good models just with bad data. There is a set of guidelines and processes to mitigate model risk, which include documenting the model, validating it, independent audit, and more.